Hey you guys, my name's Christina. I'm just a therapist. I am not any kind of financial advisor. I have started trading options recently on Robinhood and Thinkorswim after getting in solely to buy stocks and thinking that I was going to be some kind of day trader and they were going to go up and I was going to make Tim Sykes money. But the more that I'm learning, that is not exactly how this works. So I'm going to give you a more realistic perception from my point of view about how this happened. So I've been trading for 3 weeks. 3 weeks. I'm still a noob, right? So I am studying like crazy out here. I'm reading everything I get my hands on. So basically I came in thinking that I was gonna put my $5 grand into some stocks and they were just gonna shoot up and I was gonna double my money in like a day, right? I mean, honestly, like that's kind of what I see a lot of people thinking out here. So which stocks should I put my money on? I got $10,000, $5,000, $100. What's going up now? And I'm like, oh, they're doing the same thing I did. They thought they were going to be day traders in here. Well, there's a whole lot more market research that you have to do to find that stock that's going to do what we call breakout. And it's on a breakout that you can make that kind of money. Now, so just know that whether you're trading stocks or options, you are going to have to study, chart analysis, trend analysis, gap fills, target prices, like where these stocks are going. That's one part of it. The other part that you really need to focus on and be in the know about is the news, because news, positive or negative, is going to drive that stock price oftentimes up or down. And then you need to be familiar with the company a little bit. That's not something I do as much, and I've made some money, I've lost some money too, but that's not something that I've delved into a lot yet, is understanding the financial side of the business and where they're going. I have noticed in the news lately that whenever a company like Nike releases their earnings for the quarter, their stock does go up. And so that can really drive some things, or it may not. So it's just a risk and you're basically betting. All right, so let's move into options. So as I was trading stocks in the Facebook groups, I kept seeing, in Robinhood, I kept seeing people in the Robinhood Facebook group say things like, stocks are dead, options are where it's at. And I was like, what are options? So, you know, I'm a therapist, like I'm a research-based practitioner. So I did my research. I started reading and watching YouTube videos, YouTube research. Yesterday I was at the library. I have like 15, 20 books. Like I want to know how to get some financial freedom in my life. So, this is what I learned about options, okay? They are faster money. They are for people who want to see their investment in the stock market like boom and take off, right? You can either be a buyer of an option or a seller of an option. That is what I've learned like in the last couple of days, is about being a seller. So if you own 100 shares of any company, you can sell an option. You can sell a call option that gives people the opportunity to buy an option that's going up at different strike prices, and then they pay you a premium and you get to keep the premium. I don't exactly know, like, if it's in the money, do you keep the premium? Yes, it is, because I've been in the money and I still had to pay the premium, and then I get all the money that I'm in the money. But whenever your stock price is multiplying by the 100 shares that you purchased at a discount, you made well over your premium. So they keep the premium, good for them, and you keep all your money times 100, because that's how many stocks that you bet on, right? Okay, so if you own 100 shares, you can sell a call where they give people options to buy stock that's going up, or you can sell a put, which gives people options to purchase options that are where the stock price is dropping for a premium, right? So premiums are usually 2 to 10% of the stock price at a strike price, right? So there's a current stock price that is fluctuating all the time, and then there is a strike price, which is where you bet the stock price is going. So it can go up, which would be a call, or it can go down, which would be a put. Now, I did own 100 shares of Sundial. Oh my gosh. I owned 220 shares, right? I bought it high like an idiot, and I sold it when I was losing $100 because I got tired of sitting on it. I felt like my money was better served just to pull it out and say and stop my losses rather than let it sit there and wait for 50,000 years before it goes up, or they get delisted and I lose all of it. Okay, Tim Sykes' principle right there, because he was like, I'm just gonna pull my money out so I can minimize my losses. So that is something you want to consider as a trading strategy. Now, had I known about selling puts and calls before I sold those 220 shares on Friday, y'all, it's Sunday, then I would have kept them. I would have exercised that option. I would have bought the shares of Sundial again. And well, I wouldn't have to. I would have kept the shares. And at 5 cents. That's what it would have been. Because I said, oh, I put a put option in and it's going to go below 5. No, it wasn't in the money ever. I don't know. No, I already own the stock. Sorry. See how confusing it can be? I already own 220 stocks. So I could have been selling call options and put options. But I sold them like an idiot because I didn't think the stock was going to move. And I wanted to take my money out and cut my losses. Well, I could have been getting premiums that the buyers of the options would have paid if I would have, because I already owned 100 shares. Now, let's turn that around. I didn't even know that until 2 days ago. Well, that means that I was only a buyer of calls because I was buying 100 shares of calls at a time. So this is how that works. There is a stock price, a current stock price, okay? And then there is a strike price that says it's going up to this amount, it's going up to this amount, it's going up to this amount. Well, for each of those amounts, there is an associated cost to buy 100 shares. It is a discounted premium to buy 100 shares. So if the stock price is $100 and I think it's going to $101, I'm going to pay a higher premium, so closer to that 10%, to buy 100 shares. So if I don't have, let's see, math don't fail me now. If I don't have $700 to buy 1 share of Tesla, I damn sure ain't gonna have enough money. What is it? $7,000 to buy 100 shares of Tesla. But what I can do is buy an option on it if I know, strongly feel that it is going up, because we don't know shit out here, right? We're just making educated guesses. If I feel that it's going up, then I can say, boom, I'm going to pay a discounted rate to get Tesla at $5,000. And when it goes up and I'm in the money, then my money goes green, and I get to multiply the stock price that I sell it at, that it went up to, times 100 minus the $5,000 that I paid to get that option, and then that's my profit, right? I do have to pay capital gains tax, which is 28%, because if I don't exercise the option, which means that I can keep that stock for the price that it reached, then I just take the profit. And that's how people are profiting off options fast. But you do pay a tax of 28% to any stock that you do not keep longer than a year. Stocks that you keep longer than a year, if you sell them like in the next year, you pay less than that, right? It's not the capital gain tax rate. So that's buying a call. Buying a put is where you think that it's going to go down. So you got the current stock price, and then people who sell puts will sell you the premium, which is the discounted rate, times 100. Like if it's $100 stock, they might sell it to you for $5, $10, $15, $20, $30, right? If it's closer to the current stock price, it's going to be higher. If it's really far out of the money, away from the current stock price, then it's going to be a much lower premium. So And if that stock goes down and it gets, it can already start making you some money, right? But if it gets in the money, it's going to start multiplying whatever the current stock price is times 100. And that's whenever you see a big boost of income for trading stocks. Now, there's people like me who are just like, I'm just going to buy one contract, right? And that's what you should do. You shouldn't just jump in there and say, I'm going to put 10 contracts on this because I'm betting it's going to go up. Well, you might lose all your money. Okay, so like I did when they expired, because here's the deal. People told me not to, if you're a newbie and you don't understand this market, do not buy options that quickly expire, and you will get a severely discounted amount of money if you pay a premium because you think that stock is going up in 1 or 2 weeks. Okay, like I did. That's how I lost my money this past week. I said, oh, I think that American Airlines, United Airlines, CVS, and the biotech vaccine, I think they're just going to shoot up in a week. And they all went down and they stayed down, and I lost all my money on those. Like, my options expired invaluable because their stock price that they had dropped to was below the call price that I said it was going to strike up to. And so it wouldn't do me any good to buy 100 shares of those companies at a much higher price than they were currently trading for. Do you follow me? Okay, so with that being said, the time factor has to do with the Greeks. The Greeks, you'll hear that the longer you stay around options, and you need to understand and know about it. I've never been more excited about math in my life until it started lending to my financial freedom. But it can also lead to my poverty if I am too greedy again. So here's the deal, theta. All right, theta is one of the Greeks. This one has to do with time. So if you buy... let's just talk about premiums briefly. So if you get an option, right, you are going to pay more for an option that is close to the current stock price. We say close to the money, whether it's up or down, right? So you're going to pay more for that premium. The farther away from the money that you travel, you are going to pay less, right? Because the stock has to go that much further to get you in the money. Now, that's one thing. Price is one thing, right? Your premium and the stock price. Those things are going to go hand in hand. So the next thing on an option that you select is the time factor, right? So how long do you want before that option expires? So if you pick one that's going to expire in a week, an option at a strike price is going to expire in 1 week, how much you going to pay? Way less, right? Because you got less time for that shit to happen. So that's what got me in trouble. I was buying something that expired in 1 and 2 weeks. So my recommendation for anybody new is to pick a far out date that you can afford. So like a February or a March date. It is currently December the 19th. So now my options are expiring in February and March, whereas in early December they were expiring in January 15th, January 22nd. So make sure that you set that option out. Find you one, you know, before all the news gets crazy and the stock has already jumped up, that you can afford, right? That's out there, but you can afford it. It's not like crazy away from the current stock price. That is still something that I'm learning, is how to set the strike price that you think it's going to strike up to. The trend and chart analysis tells you that. So I went ahead and paid to be in a group. I'm paying $40 a month, and it earned me $1,500 in the first 2 weeks. It was worth it. These are not professional traders. They are just people who make their living by sitting at home all day long watching these charts, or working like me. There's a few people in the group that work like me, but we all work together to like say, hey, what about this stock? Can you guys look at this one and analyze it? And then they're using their charts to analyze it and make an educated decision about whether or not the price is going up. It's called Kings of Discount Trading Options on Facebook. You can just get in that group and see what we're talking about on Facebook. But you'd have to pay like $40 a month to be part of that group to to be able to talk about different stocks, and it's in no way like an insider trading thing. Like, you have to play at your own risk in the stock market. So is there any other questions or anything else? Please don't give me any mean comments. Some people are so mean in the stock market, but I was just trying to have coof, but be honest and keep it real with y'all. So that is the quick and dirty on calls and puts. There's so much more. You better be ready to study if you're going to do this and learn about this stuff, because it is, you can lose your ass out here. Okay, be careful. Bye.